Domino's Pizza Stock, ticker symbol DPZ. This stock has been on my radar for a long time. But is it already in the buying range? The stock is nearly flat year to date and dropped twice significantly, of which it recovered also twice. Since the most recent drop, DPZ stock is up 16%. From a dividend point of view, things look pretty interesting with dividend yield at 1.44%. But it's all about the growth, almost 18% CAGR in the past 5 years. On the 27th of April, Domino's presented quarter results where they beat on EPS but missed on revenue by a small margin. For the upcoming earnings, analysts are very optimistic. So does this mean that Domino's Pizza stock is a buy at current prices? Well, I'm very excited to see what you guys think about this stock, so please let me know your thoughts in the comments. My name is Thomas and this is Thomas Invest. I'm an investor looking for great stocks at great prices. So, what does Domino's do? Domino's is a restaurant operator and franchisor with nearly 19,000 global stores across more than 90 international markets. The firm generates revenue through the sales of pizza, wings, salads and sandwiches at company-owned stores, royalty and marketing contributions from franchise-operated stores. Domino's is the largest player in the global pizza market, ahead of Pizza Hut, Papa John's and Little Caesars. If we dive in the most recent earnings report, we see some interesting highlights. Global retail sales increased 5.9% year over year, and US same-store sales increased 3.6%. To me, it's very important that same-store sales is also growing. Domino's can easily increase revenue by opening new stores, but you want them existing stores also to be growing in revenue. International same-store sales grew 1.2%. In total, Domino's store amount grew by 128 new stores. EPS was reported at $2.93, up 17.2% year over year. This looks really good to me. Last year it was reported at $2.5, but due to higher net income and less shares outstanding, the EPS increased really nice. In here we see the same store sales growth once more. US company-owned stores increased 7.3% versus minus 10.5% last year. Franchise increased 3.4% versus minus 3.2% last year, and international stores decreased 0.5% versus 2% last year. So that's definitely something to keep your eye on. But if we exclude foreign currency impact, we see a 6.5% increase, which is much better already. And in here we see an overview of the store count. As said before, opening new stores can easily increase the revenue for Domino's. In total, 128 new stores were opened, of which most are international stores. The trailing fourth quarter also looks pretty impressive with 947 stores, and again international representing most growth with 836 stores. US franchise is the second biggest segment with 6,423 stores, while international is the biggest with 13,300 stores. The last thing that I want to cover before diving into the fundamental part is the revenue and margin breakdown. Total revenue increased only a tiny bit, because US company-owned stores decreased year over year in revenue. But the cost of sales also decreased a tiny bit from 63.5% to 62.4%, which is a good thing. Gross margin increased because of this from 36.5% to 37.6%. Bottom line, we also see a higher net income margin, 10.2%, this year versus 9% last year. To me, this looks pretty good. And now that we know more about the company, it's time to check the fundamentals of this stock. But first, if you made it this far into the video, I want to thank you a lot for watching this video. Make sure to subscribe to my channel to receive multiple analyses every week. And also join my Discord channel for free to meet other people within the community and to talk about stocks. It's completely free, so don't miss it out. Let's continue by diving into the fundamentals. Domino's is a 11.93 billion market cap company. PE ratio is at 25, which could indicate that they are at a premium price right now. Later in this video I will show you my 3 price targets for DPZ stock. So make sure to watch until the end, because PE ratio is only telling a small part of the full story here. Revenue is at 4.51 billion, and in this graph we see that revenue went up really nice and steady. Over a longer period of time, margins are going up, which is something that I really like. In 2022, margins decreased due to multiple reasons, but as of lately, margins are increasing again, which is a good thing. EPS is going up really nice and steady in 2022. They were struggling a bit, but it's increasing again, which is a good thing. Analysts expect low double-digit growth in EPS in the coming years, which looks pretty good to me. For the revenue, it is also looking quite interesting at an average of mid-single digits. Return on assets is sitting at 25%, which is a great number. And the most important number, return on invested capital, is sitting at 44%, which is also a really good number. To me, this looks really good. Current ratio is at 1.49, which looks pretty good to me. Over a longer period of time, it's always between 1.2 and 2, which is fine by me. Total debt is sitting at 5 billion, and I prefer companies that can pay down at least a third of the total debt with the total cash position. Right now, total cash is sitting at roughly 154 million, so they can't pay down a big chunk of their debt, which is something that I don't like. So to me, it's very important that free cash flow is growing, since this is used to pay down debt of course, but also to buy back shares, pay dividends and all other things. And in here we see that free cash flow is going up quite nice and steady over a longer period of time. Most recently we see a decrease, but it has to be said that previous years were impacted by lockdown periods and were showing higher growth. So to me this doesn't worry me at all, since current numbers are aligning with previous growth numbers. A thing that I love about this company are the shares outstanding. It's going down in the long run. It means when shares outstanding are decreasing, it increases your ownership in the company, increases the EPS, lowers the PE ratio and makes it easier to increase the dividends. And since we're talking about dividends anyways, dividend yield is sitting at 1.44%, which is not the highest number of course. Annual payout is at $4.84 and payout ratio is at only 35%. I prefer 50% or lower, so right now they have roughly 65% left in cash to buy back shares, pay down debt, acquisitions, open new stores, research and all other things. The 5-year growth rate is at almost 18%, which is a great number, and one of the reasons why I love this stock so much. On top of that, they grew the dividends for 9 years in a row, which is also pretty nice. And if you take a look at these numbers, the dividend paid since 2013, you see almost a 20% increase in dividends every year, which is really nice. Payout ratio is a very important metric with dividends. It tells you if the dividends are safe. In here we see that over a longer period of time, payout ratio is always between 25 and 35%, which is a decent level. Most recently it is increasing, but I expect payout ratio to go back to 25 to 30% in the coming quarters. In this graph we see the expected dividends in 2023, 2024 and 2025. Of course this is an estimation and can be highly impacted by results, but it gives you a rough indication. It's expected to grow at historical numbers, which is very nice. Overall these dividends look pretty good to me, but how about the historical returns? I decided to compare Domino's pizza stock with the overall market, in this case the S&P 500. Next to that I added some competitors, Wendy's, Wingstop and Papa John's International, ticker symbol PZZA. On the 5-year chart we see that Domino's had a 25% return including dividends and underperforming the S&P 500 and competitors big time. Wingstop had a phenomenal return of 344%. On the 1-year chart it looks pretty different. Domino's had a 43% return versus the S&P 500 returning 32%. Both Wingstop and Papa John's had the highest return. On the 6-month chart it's pretty different again, with DPZ returning flat numbers, but both Wendy's and Wingstop beat the S&P 500 big time. On the 1-month chart it's DPZ stock returning a minus 8% versus the S&P 500 sitting at 5% return. Wingstop had again the highest return. So bottom line, Domino's was beaten by most competitors and the S&P 500 in the long run, but also most recently. Could this mean that DPZ stock is a buy at current prices? Well, let's check the 3 price targets that I created using the Everything Money software, which is one of the best tools out there. I'm using a low, mid and high assumption to get the 3 price targets, starting off with revenue growth. For the revenue growth I'm filling in 4, 5 and 6%, since I think they will increase the revenue at similar numbers versus the historical averages. Next to that, it's also based on the analysis expectations and the current outlook. For the profit margin I'm filling in 10, 11 and 12%, based on their own current outlook and current performance. I put in the same numbers for the free cash flow margin. For the PE ratio and the price to free cash flow I'm filling in 20, 22 and 24. It's the biggest pizza delivery company in the world and they are still capable of growing at decent numbers. My desired annual return is 12.5% since I can get an easy 10% average annual return with owning an ETF. Right now DPZ stock is at $336. I hit analyze and we only see red numbers. We have a low price target of $193, which is a big drop from the current stock price. We have a mid price target of $243, which is still a big drop. And we have a high price target of $303, which is a 10% drop from the current stock price. To me, the mid to high price target is the most justified here. And as said before, it's a big company that is capable of growing at decent levels. But it's not expected to see double-digit growth in revenue, which is a big influence on the price target. My final conclusion on this stock is that I can't wait until they hit the $250 mark. I have been following this company for so long and most fundamentals look good, but the valuation is a thing. I do think a premium can be justified given the fact that they are the biggest pizza delivery company in the world and dividends are growing at an insane number. But you shouldn't overpay for the growth. For now I'm just waiting for the stock price to come down a bit and they hit the $250 mark. I will definitely analyze them again to see if they are a buy. With the upcoming earnings this could easily happen with all analysis being very optimistic but the company reporting disappointing earnings. For now we can only wait to see what will happen. And remember to always do your own research and never fully trust on what I or other YouTubers say about a stock. I'm not a financial advisor and this content is just for entertaining purposes only. I hope you liked this video and I did bring some insights of the company to you. I would really appreciate a thumbs up and make sure to subscribe to get notified when I'm posting a new video. Thanks for watching and I will see you in my next video.